Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be taking a look at Molson Coors beverage stock, ticker TAP. This one came in by request down in the comments section of one of my other videos. If you have a request of a stock you'd like me to take a look at, just put it down in the comments. I'll get the ticker on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500, like Coors is, I post those on YouTube for free. The rest I post over on Patreon. At the $5 tier per month level, you can request any stock you would like me to take a look at that's not in the S&P 500 over on Patreon, and I'll make a video or I'll reply to you in the chat room or via direct message with what I think about it. And then I also have a new weekly stock pick service over on Patreon at the $25 a month tier level. And I just started that last week. We have our first idea up there, so consider checking that out. Those links will be down in the description. I also have a 25% off affiliate link for Fast Graphs, which I'm going to be using this entire video. So it's a pretty useful graphing service. And I think they have, I don't know if it's 1 week or 2 week trial, so you can try it for free, but you'll also get that 25% off discount if you've never tried it before. So make sure to use that link down in the description for that. And if you join any of the Patreon tiers, paid tiers, if you ever decide to join the full Cyclical Investors Club service on Seeking Alpha, you get a big discount. So check all those links out. If you have any questions, just ask and I will answer them. Or if you have any requests, put them down in the comments and I'll get to them. Okay, so Coors. So this is going to be a little bit different than some. So this is in the S&P 500. I actually don't track this ticker because the earnings growth has just been too slow over time. So if we just move the graph here to, let's just say 2011 or 2012, and then we shorten this to this year. I actually owned this stock at one point. I want to say it was back around this period. I owned it for a little while. It was before I started the Cyclical Investors Club service. I started writing about stocks in 2015 on Seeking Alpha, and I think it was one of the earlier ideas that I had, and I want to say it didn't really make very much money, or maybe it broke even or lost a little bit. It wasn't exciting, but it didn't turn out how I wanted it to. I think the interesting part about that is the thesis that I had for buying the stock had to do with M&A. So maybe it was when Molson and Coors combined. I can't remember. Or maybe they got Miller Assets. It's been a long time. But I kind of use the opposite opinion that I was using to buy the stock back then, which I thought was interesting. So usually I avoid stocks now if there's like bigger M&A, and part of my thesis back then had to do with the M&A would eventually lead to a higher stock price. So I don't know if I learned a lesson there or what. It probably took me a few other times before I figured out that most of the time M&A is not what I want to see. But as it turned out, the stock fell. I mean, oh my goodness. So I didn't hold it all this time, but yeah, 70%. Holy cow. From peak to trough. And now it's kind of coming back a little bit. But what I want to focus on here is this dark green shaded area, which is the earnings growth. So the earnings growth here is about 3.3% per year, starting at the beginning of 2012, and then just measuring, if you measure it in a straight line, up to the end of this year expectations. Now, they've actually had years where they declined during here. When I do my manual calculations, I take those into account. But Fast Graphs does just basically point to point. But you can set the years up however you want. So it will adjust to whatever time frame you put on here. But at any rate, a 3% earnings growth rate during what is probably going to be close, maybe a 2.5 to 2.7 inflation environment, basically means the earnings haven't grown for 12 years or 10 years or whatever. They really haven't grown much. Now, they did come back pretty strong in 2023, it looks like, after being depressed for a couple years. But this year's only expected to have 8% earnings growth. Sorry, this year's expected to have 6% earnings growth. And then 2025 is, again, 3%, 2026, 4%. So for me, one of the main benefits of owning stocks is that if it's a high quality business, it can pass inflation on to its customers by raising prices if there's inflation, right? So you don't get that in a bond, you don't get that holding cash, you don't get that in your savings account. I suppose there are inflation protected bonds, but usually you pay a price for that, and the ultimate real yields still are quite low compared to what you can get in a quality business if you buy it at a good price. These guys also, I think probably a person would ask me about this because the PE is only about 10, okay? But if you go down and you look, the market caps, we'll call it like 10 billion, and then we'll call the total enterprise value, which includes the debt minus any cash, is about 15 billion. So that's roughly 50% more that you would actually have to pay to buy the business because you have to buy its debt as well, its obligations. All right, so one way to think about that is instead of this being a 10 PE, really it's more like a 15 PE if you're really going to buy the business and the debt. So when it's a 15 PE, it doesn't look nearly as enticing. And because of that M&A that I talked about way back when, they've carried more debt since then. So it turned out to not be such a great thing, and that's why the stock price that used to trade at a 25 PE, even along with the fact earnings growth has flattened out, at one point was down to these single digit PEs that we see. It's because debt's higher and growth has been slower. So to me, that's all like pretty explainable, and this PE is probably in this market like fairly valued. Like it's not cheap if you ask me, because historically, as I showed, earnings growth was like 3 to 4%. Looking forward, analysts are expecting it to be 3 to 4%. So you get, we'll call it inflation rate earnings growth. And that's if nothing gets disrupted in their business. So I do think that perhaps now more than ever, there's more competition look at all when I was a teenager, you could count the number of like microbrews on a couple hands, maybe in the whole country. There were probably more than that, but there really weren't very many. Like it was like a unique thing to see like a microbrew. Unless you were in like, San Francisco and just a couple other places that were that had a few of them. And now they're everywhere. So the access to capital and information and people's willingness to drink something other than Bud Light or Coors Light or Miller Lite has expanded a lot over the past, say, 30 years or so. So there's a risk of disruption there, I think, for sure with this stock. And that goes for Budweiser too. And we also have the issue of what we know so far is these weight loss drugs, the GLP-1s. Not only can they reduce your appetite, they can also reduce the desire to drink alcohol. So that's further pressure that could be. So the point I'm trying to make is we could go from 4% earnings growth to negative for some of these big companies over time. And so I think the bigger risk, there's more risk that earnings growth will go negative, since it's right on the borderline now, then it will start growing 10% a year all of a sudden, like for multiple years, which would be the upside potential. So to me, there's just more downside risk than there is upside reward potential for Coors and Budweiser and even like a Brown-Forman. And they're pretty big companies too, so they aren't too nimble. Now, so that's why I would just avoid it. But I do think, like, if somebody made me buy one of these, it would probably be Sam Adams or Boston Beer. I don't know what, yeah, they call it Boston Beer. So Sam Adams was their flagship beer. We look at this. This is when their, I forget which one was theirs. If it was, you had White Claw and Truly and some of these other like hard seltzers come out. And there was kind of a boom in that. And then, of course, everybody, got drunk during COVID because we could all just stay at home and drink all day. And so the stock got a little crazy here. And then we had the bust after that where all this leftover inventory was that they thought they were going to sell was there and they couldn't sell it right away. And so they took this big hit. And now things are starting to kind of level out for them. But at least what's interesting here is you have 20% plus growth potential with a 32. Now, it's not cheap. Again, this is probably fairly valued. If they grow 20% for the next decade, a 30 PE isn't too bad to pay. So it's gone from being kind of crazy to fairly valued. But the thing is, they don't really have any net debt, and they're less than $3 billion market cap. So Sam Adams or Boston Beer, they're relatively small compared to these other big makers. And so if I was going to take I think I do actually track Sam Adams, but if I was going to take a chance on one of the beer makers and alcohol producers, probably Boston Beer is where I would be leaning. It's traded, if it has like has like a hiccup at some point, we've seen it down about 20, and because it had a couple of years back in 2016 where there wasn't much growth or even a little decline. So if you get down around that area, which is maybe, we'll call it 30% lower, give or take, they've been able to do pretty decent since then, even with all the turmoil that they've kind of had. So that would be more enticing to me. Also, they could get bought out at some point as well. And they're small enough. If they're growing 20%, that's going to be an attractive proposition potential. Now, I don't know if they would sell out. But that, at least that potential is there if you buy it at a pretty decent price. Now, just generally speaking, with the beer companies especially, I just don't think people drink as much as that. Younger people are not. I live in a college town. I'm a Gen Xer. And I just don't think younger people are partying as much as we did when we were younger and throughout our entire lives. Just a side anecdote, I've been rewatching the sitcom How I Met Your Mother, which are a bunch of, they would be kind of latter Gen Xers, that were born in maybe like the late 70s and were going to college in the mid 90s. Which is kind of where I'm at. I was born in 75. But I watched the show, which is kind of a memoir to some degree, more than other sitcoms. And they're hanging out. It's not Cheers where the show is set in the bar, but they're hanging out in the bar and drinking in every single episode. It just kind of struck me, as I've been watching it lately. I don't think like millennials are doing that, or Gen Z or whatever now. Not to the same degree. So it makes me wonder about the long-term growth prospects of any kind of alcohol producer. If you're only paying like kind of a fair price, I think you want to get them cheap to get a margin of safety. Because while it's fun to spend your life drinking beer with your friends, it's not the healthiest thing to do long term. And the people who are, my age and the boomers that are older, a lot of them are dialing back some of that now too, to try to live healthier lifestyles. So I think that's probably, an uphill battle that almost all these, especially the really big ones, Budweiser, probably like a Heineken would fit into there. I don't know if they're owned, I forget who they're owned by now, or if they're own their own brands and stuff. I Can't remember. Maybe I could type it in here and see. I don't. Oh, there we go. Heineken. Answer my own question. Okay, so again, we have the last 2 years negative. We'll call it flat earnings growth, leading into COVID, mid-single digits earnings growth, and then analysts are a little more optimistic lately. And with that very slow earnings growth, you still have a 15 PE, right? And a huge, they're huge. I didn't realize how big they were. $45 billion billion euro business. So with a business that big, it's just going to be, I think, hard to grow like they were able to grow back in the day, right? And even then, the growth wasn't fantastic. Let's get COVID out of there. Yeah, I mean, well, I can look on the fast graph. We'll call it 6 to 7% earnings growth. Now, this was during a time when there was a little bit of deflation, so there really wasn't much inflation. So that's pretty good growth. But the days of really great growth, I think, are gone for the foreseeable future for pretty much all these alcohol producers. So that's my thoughts on not only Molson Coors, but Budweiser, and pretty much all the alcohol producers. I think you'll have to find certain special situations if you want to make pretty good money in these stocks. All right, thanks for watching. If you found this video useful, hit the subscribe button, hit the like button, check out the Patreon links. I have a free tier there too, so you don't have to pay anything. You can join there, and then that way you'll get all my videos. I post all these videos over there too, plus some extras. So thanks for watching. I'll see everybody later.